Don't make this rookie investing mistake. Oof. I'm glad I got this email from this guy. We'll call him Bill. Chill Bill. All right. Oh my God. Wait. Oh, you see that right there? That's how Pablo treats my pool. See that right? Look at that. Yes, I'm talking to you, baby cakes. I don't know if y'all can see. Oh, there he goes over there, Pablo. Where'd he go? There he is. So Pablo just literally craps on my pool deck. Oh boy. At least Finney knows to go in the grass and send the boys to do poop patrol because Finney drops bombs. Anyway, so my man Chill Bill, he writes an email here I'm going to share with you here. Check this out. And this is not a bash on Chill Bill. Not at all. Not at all. I appreciate him emailing me because this kind of got me off the snide. Is that the right word? Whatever. The stump to revisit my investing basics course because I kind of put it on hiatus for a couple weeks. Problem with when you're right, I'm just telling you, if you don't do it every day, you lose your muscle memory, and then you kind of get out of the rhythm. You got to do it you just got to force yourself to do it every day. I haven't written for 2 weeks, and so out of sight, out of mind. Anyway, so this email prompted me to say I need to get back doing this because, all right, so my man Bill writes in, am I missing something in thinking it does not make sense to put bonds in your portfolio when looking at the performance results between the Vanguard Bond, I don't know what that is, VBLT, Total Bond Index, okay, there you go, and Schwab's Dividend Equity Fund over the 10 periods that are available. All right, so Joe Bill is comparing the Total Bond Index versus the Schwab Dividend Equity Fund. The upsides look huge for the Schwab fund, and the downside seems small. Oh, I'm stunned by this. He goes, the standard deviation seems to matter very little. Am I missing something? Oh my goodness. Ooh, all right. So what we have here is a classic case of chasing returns. So the first thing we have, the upside looks. It was huge in Schwab relative to bonds. It was. All right. So we're conflating what looked to looks. We don't know what the future holds. We have no idea at all. None whatsoever. We're looking at the past 10 years and we're saying, look, 10,000 invested in the Schwab Dividend Equity Fund is worth 40,000 today, whereas 10,000 invested in the bond fund is only worth 11,700, which means a compounded annual growth rate of 1.42 versus 12.68. Yes, if we knew for sure that would happen the next 10 years, we'd say, yeah, why would we touch bonds? But hang in there because I'm going to show you something here that's going to blow your mind here just a little bit. Don't get off here. Standard deviation, 4.21 versus 13.73. All right, why is the standard deviation so high? Well, because look at the best year. I mean, this is why. So remember, standard deviation is just the variance around the mean. So it's the square root of the variance. Yeah, it's the square roots of the variance. So you take the variance. So you have the mean. All right, so you have a mean 5, whatever. Actually, we can say the mean here for Schwab was 12.68. That's the mean. That's the average rate of return, 12.68. So how much was it variant around that average, if that makes sense? All right, well, standard deviation, it varied a lot too on the upside. Look at this. We got essentially, 2 standard deviations right here. 2 standard deviations, yeah, on the upside. Yeah, right about 2 standard deviations on the upside. All right, and then we had about 1.5 standard deviations on the down. I mean, so standard deviation isn't just the highest and the lowest, best year, worst year. It also says on any given 6-month time frame and all that too. So what did Schwab do during the 20s? It probably went down more than 5.56%, but it didn't go down for the whole year. So the standard deviation is implicit in saying what is the volatility around the mean regularly, not just on an annual basis. Hope that makes sense. Anyway, so the standard deviation of Schwab, it seems odd to him because he's like, well, the worst year is only 5.56, where the worst year of the bond market was a whole lot more, and yet the standard deviation was less. Yeah, because, again, the standard deviation is regular volatility around the average. And, in fact, this case, the bond market actually completed 2022 with its worst years ever had. All right, where Schwab over the last 10 years, the worst year is at 5.56, which is quite good. All right, then we look at the max drawdown. This will give you a better gauge of the worst time frame. So the max drawdown from Schwab was 21.54%, and that was most likely in 2020. All right, now I don't know for sure. I can almost guarantee it. All right, so the bonds is less. All right, so basically what Bill is saying, he's saying The upside looks huge because look at that. Well, versus look at that. The standard deviation seems to matter very little. All right, well, it mattered very little unless you were sitting there in 2020 and you're like, and people were, man, people were. Am I missing something? All right. So what we want to do, we don't want to compare the last 10 years and assume that's what we're going to get in the future. Let me show you something else, because if we're going to do this, we can make a similar argument, which I'm going to do in my course. So check this out. I can read this from you. Read this. Peter Lynch ran the Fidelity Magellan Fund from 1977 through 1990. He clocked nearly 30% a year. If you invested in Fidelity Magellan when Peter Lynch took over in 1977, you have doubled your money every 2.5 years. That is an absurd growth rate and hard to imagine anyone ever coming close to beating that again. In fact, Lynch never came close to matching those numbers himself. You can see I have a lot of typos in there. I haven't corrected this or anything. It's just really my first draft. From 1985 through 1990, when he retired, he clocked a stellar 18.86% rate of return, but the S&P itself averaged 15.66. Right? And all good things must come to an end, and after Peter Lynch retired, the Fidelity Magellan Fund has been underwhelming at best. The issue is, of course, that no one knew who Peter Lynch was in 1977 as a fresh-faced 33-year-old young man taking over the fund. You wouldn't have invested with him. Neither would I. And you wouldn't have invested in a Fidelity Contra Fund when Bill Danoff took over in the early 1990s either. And I talked about the Contra Fund up here before that. All right, so let's keep going here. You only know about these impressive fund managers after the fact, after they already hit their Grand Slam home runs, or what Peter Lynch in his book Went Up on Wall Street called 10-baggers, stocks that go up tenfold. Can they do it again? Sure. Bill Danoff proves it can happen, but what will happen again? Or are they just lucky? Someone always has to beat the market. Check this 2009 article from Forbes, which screens stocks to buy similar to the methodology that Peter Lynch would follow. I looked up each one, and not one of the 10 they identified in their stock screener beat the S&P 500 from from 2009 to May 2023. You hear that? So Forbes did a stock screener using the methodology that Peter Lynch used, and not one of the 10 stocks beat the S&P 500, and it wasn't even close. If you followed that stock screener based on trying to mimic Peter Lynch, you'd have been crushed by the S&P 500 over the last 14 years. In fact, history is replete with stories about exceptional fund managers falling out of favor. Here's Bill Miller. He had an incredible streak of beating the S&P 500 for 15 consecutive years. Here's the Legg Mason Value Trust. Here's the S&P 500. But what happened next? Legg Mason Value Trust, S&P 500. Am I the only one who remembers this from the Wall Street Journal? Best stock fund of the decade, CGM Focus Fund. And here it is, Eleanor Lace. Meet the decade's best performing U.S. diversified stock mutual fund, Ken Hebner's 3.7 CGM Focus Fund, which rose more than 18% annually and outpaces closest rivals by more than 3 percentage points. Did you read that second part, though? Too bad investors weren't around to enjoy those gains. Those typical CGM shareholders lost 11% annually in the 10 years that ended November 30th. They lost 11% a year. Why? Because investor returns can be lower than mutual fund returns because shareholders often buy a fund after it already had a strong run. So what did the CGM Focus Fund do after they wrote this article? It got crushed. Here's the S&P 500. Here's CGM Focus Fund. Would you invested in the CGM Focus Fund in 1999 before it had its amazing 10-year run? I doubt it. You've never even heard of the fund. So the only time you invested in it would have been after it had its amazing 10-year run. And guess what? You would not have been rewarded. Over the next 14 years, you didn't even double your money. Yet in the S&P 500, the boring old S&P 500, you nearly quintupled your investment. What will the future hold for this fund? I have no clue, but I don't care to find out. You shouldn't either. Oh, but wait, the hits don't stop there. You ever heard of the USA Gold and Precious Metals Fund? No? Well, it's only the top performing fund of the previous decade. Previous decade, I should say the aughts it was. From 2000 to 2010 is the top performing fund. Consider gold right here. Look at that. 10-year, 28% rate of return annualized. 10-year. Gold is grabbing investors' attention again. It hit a record high last Thursday when the stock market plunged. The Dow fell nearly 513 points, its biggest drop since 2008. Some financial analysts think that investors afraid of risk should still take refuge in gold, although the price has shot up 73% since the last 2 years. All right, so here we go. USA Precious Metals Fund. It was up 28%. So my man Chill Bill here would say, well, why would I buy an S&P 500 fund? I should just buy the gold fund because the last 10 years it did so much better and the standard deviation was higher, but there seems to be little risk. $10,000 invested in the gold precious metals fund was worth almost $125,000 at the end of 2010, averaging well over 25% a year. Look at that. That's gold. That's S&P 500. Just like the other funds, what happened next? Gold. $10,000 invested in the USAGX in 2011 is only worth $4,987 by May of 2023. You've lost 5% a year in that fund over those 13 years. You see the consistency? A huge 10-year run is typically followed by huge falls. Interestingly, though, if you had enough foresight to invest in the three previous mentioned funds, a Legg Mason Value Trust, CGM Focus Fund, and the USA Gold Fund, and put a third of your money in each at the start of 2000 and rebalanced, you'd have actually outperformed the S&P 500 over the 23 years from 2000 to 23. Look at that. Here's the three blue funds, and here's the S&P 500. But again, the problem is you never would invest in those in the beginning of 2000 because you know where they were. No one knew these funds because they hadn't done anything up that point. From 1985 to 1999, the USA Gold and Precious Metals Fund made no money, whereas the S&P 500 averaged nearly 19% a year. The Legg Mason Value Trust did a little bit better than the S&P over that time, averaging 19.37. That's not enough for anyone to take notice, especially given its high expense ratio, which is over 2%. The CGM Focus Fund came into existence in 1998 and averaged all 5.96% the 2 years up to its 2000 when it took off at nearly 25%. So just to reiterate the point, no one knew these funds were going to go bonkers in the coming years, and after the fact, that was one that only caught people's attention after the fact. All right, so going back to Bill's thing here, talk right about it. Yeah, it's good. Look at me, crushing. So what can we learn? Well, first of all, it's easier to make it's easier to make a case to pay a high fee for a stock fund than a bond fund. Remember, bond funds are fixed income. They can only return what the coupon is, no more, no less. Yes, as we discussed previously, you may be able to buy a bond for a discount and get a higher return than a coupon because when the bond matures, it'll pay their par value, which is above the discounted price you bought it for. However, the bond fund is still a fixed income. The upside is limited. The only people who'd argue against this don't know how bonds work. So to pay a hefty expense ratio for an investment as a ceiling on its growth prospects doesn't make any sense. All right, so what happens here is we don't ever compare stocks to bonds. All right, why? Because stocks have unlimited upside and limited downside. They can go to zero. That's just a fact. But it's unlimited upside. Now, to get that unlimited upside potential, you're going to have a lot of volatility. A lot of volatility. Bonds, other than last year, and the only reason it happened last year is because the amazing raising rates by Jerome Powell and the boys at the Fed, which is good. We want to see that for sure because now bonds are worth something. So Bill's missing the boat here because he doesn't recognize just because bonds have done subpar for the last 10 years that typically, I can't guarantee that. That typically means where the value is, man. Not all the time. Look, we've been waiting for international to take off like a bat out of hell for many, many moons. It has yet to happen. I think this year actually international is up pretty good, but I don't know. I don't pay much mind. The point being is bonds give you fixed income and limited downside. All right, because bonds, especially government bonds, the total bond index is 70% government bonds and agencies. So you're not losing your money there in terms of you're not going to go bankrupt like you could in a stock fund. You're just not. You know, at the end of the 10-year cycle, you're going to get basically whatever the coupon is right now. And if the coupon's 4%, that's pretty much what you're going to get in the bond fund. Now, there could be some years where it spikes up because interest rates drop, and that's what I'm expecting, which means the bonds will give you a pretty good stellar rate of return. But my issue with Bill is, and these are the things I have with people all the time. I remember when I used to be a broker, and I'd go to people's houses trying to sell them on our investments. And I met this guy in Pennsylvania someplace. Nice guy, a farmer. He lived on a farm. I think he's a gentleman farmer. And I said, man, you should buy some individual bonds, you know what I'm saying, instead of the mutual fund. He goes, why? And I say, because individual bonds, and this is back, I still kind of believe back then the individual bonds, and I think it's a crapshoot now, but it was 15 years ago. Back then, I still kind of believe that individual bonds gave you more protection against upside risk with interest rates hike than bond funds. And to be perfectly honest, I bet I'm still right there because what happened last year is the mutual funds got smoked in the rate of return because the prices went down so much. Or individual bonds, well, the prices went down. It didn't seem so bad at the end of the day. Just because the individual bond says, hey, I still have this thing. It's still going to mature at 100. With a mutual fund, you don't have a fixed maturity date. I know it's kind of confusing. But anyway, long story short, I try to sell them on this, that if interest rates go up, the individual bonds will give him less volatility, at least letting him sleep better at night. And I said the drawback about individual bonds is a coupon. Right now you're only getting 3% or something like that. He goes, well, why would I ever do that? I said, well, because the mutual funds are only paying you 3%. He goes, no, the mutual funds pay me 8%. So what are you talking about? He goes, look at the historical rate of return. I said, why would you do that? He goes, because that's what I've got. That's, if you look at the USA Intermediate Bond Fund, for instance, is average 8.5 or whatever it is. I said, yeah, but that was in the past. That's not what's paying now. What's paying now is a coupon. I mean, and he didn't get it. And he's a nice guy. He just could not grasp. He goes, why do you want me to do worse on my money? I said, because just because of what it did back then doesn't mean it's what it's going to do in the future. And he couldn't get it, like my man Bill here. I will never forget this. I felt like I let the guy down. It's like, because I was like, you have to know this. You have to know that what happened in the past is not indicative of the future at all. In fact, with bonds, we know exactly what the future holds. It holds a coupon. But that's literally just it, with a 95% probability. I should say what the yield is. Whatever the yield is right now, is not the coupon. Whatever the yield is, what you're going to get. And when I left there, I was like, I can't believe I couldn't explain that to that guy. And it wasn't him, it was me. My explanations were just, he was so convinced that the bonds of the returns of the bonds were representative of the returns he could expect. And I was like, even the prospectus says don't do that. But yeesh, it's very, very frustrating. And anyway, the long story short, it wouldn't have mattered. He still would have, got tanked in 2022 if he's still alive. I don't know. But anyway, the point being is, again, my issue was, I think you would have been felt easier grasping that you own a bond and is not going bankrupt. It's still held there regardless of the prices. You're not selling it, thus who cares? And when it matures, it's going to mature at 100 as opposed to a mutual fund. And I still believe that. And I don't know if I still believe that, actually. I'm not going to lie to you. But anyway, the point being was, that's what Bill was sitting here. He's looking at the 10-year track record of the S&P 500, basically saying it's less risk and a hell of a lot more upside versus a bond fund. And I'm like, oh, man. You're comparing a bond fund that had its worst year ever against a stock fund that just had a massive run. It's a rookie mistake, Bill. Don't make rookie mistakes. Now, if you want to be aggressive with your portfolio, I don't care. Again, though, the issue is, in my opinion, the point being is, if you take a stock, if you're going to expect to get stock returns, you're going to have to assume stock-like risks. Stock-like risks means a 57% decline from 2007 October to March 9th of 2009. Even after what happened last year, bonds never did that. And again, last year was the worst ever we've had for bonds. I mean, can it happen again? I don't know, but it freaking happened, dude. It happened in our lifetime, 15 years ago. I guess it was 10 years ago when I was meeting this guy. About 2013. 2011 and 12. 2013, I was back here. I was living in Philly in 2011, 12. Yeah, so I guess 12 years ago. Anyway, stock returns mean stock risk. Bond returns mean bond risk. And the risk in bonds is significantly less. And when you're pulling money out of your portfolio, that's why they call it the sequence of return risk, man. If we got to pull money from our portfolio for whatever reason, and the markets are down 57%, you're not going to survive that. You just won't. Anyway, all right. Hope that helps. I'm looking forward to finishing up my book here and then my course. This really got me on. I'm not mad at this guy. I'm not yelling at you, not mad at you. Just you're making a rookie mistake, dude. And it's okay to be in stocks if you want if you're willing to take the risk. I just don't want to hear people say, "Oh man," like I had one lady, I'll never forget. She's a finance professor too. She's like, why am my portfolio down? I said, because you're in a stock portfolio. She goes, yeah, but you guys are supposed to protect me from losses. I said, what? There's no protection from losses in the stock market. What? How do you not know this? And you're a professor of finance. I'll never forget that. Anyway, love your thoughts. Put them in the show notes. And again, if you like my content, And you want to buy my books, I talk a lot about, I haven't had an investing book yet, but we do talk about Roth, we talk about Social Security, we talk about, Generation X kind of thing in my strategic money planning, and younger than Generation X too. So buy my books. You can get them on Kindle Unlimited for free. They're right down there. We'll see you.